Last month, the RBA board decided to keep the cash rate steady at 4.35%, the seventh such decision since rates were last increased in November 23. The latest inflation data indicate a modest tempering of inflation. So core inflation stood at 3.4% in August, down from 3.8 and 4.1 in the months prior. So while that's still significantly above the midpoint of the target band, the trend is moving in the right direction. In its statements, Reserve Bank officials have emphasised that it's too early to predict the future direction of rate changes. This cautious approach likely reflects the Governor's intent to avoid some of the premature commitments seen in the past, as well as a need for more data to confirm a sustainable movement towards the inflation target. Unlike Australia, several other major economies have begun reducing rates already. In the US, the Federal Open Market Committee initiated a return to a more neutral monetary stance with a larger than expected 50 basis point cut in September. Similarly, the Bank of England started their cutting cycle in August. So shouldn't we just follow suit? Well, the situation in Australia differs in a couple of ways. Compared to the US, for example, our core inflation, when we include energy and food, is over 1% higher. Additionally, our rate cutting cycle commenced later and peaked at a rate 1 percentage point lower than the US. So these factors suggest a more delayed and moderate approach to rate cuts in Australia when they do come. Now, last quarter, I said the key determinant of our inflation and therefore cash rate pathway was going to be households. So what's been happening there? Well, recent data presents mixed signals on how households are responding to the Stage 3 tax cuts. On one hand, the latest retail trade data showed a robust 0.7% rise on the month in August. On the other hand, the household spending indicator was flat in August following declines in June and July. This indicator, it captures a much broader spectrum of spending. While data that we've seen from at least two of the big four banks indicates that the impact of the tax cuts on spending has been pretty muted, with households showing a preference for saving over spending, evidenced by increasing flows into offset and redraw accounts. So this is good news for inflation. Saving instead of spending the fiscal stimulus will help ease inflationary pressure. Now, the key calculation I've been doing to judge household sentiment is growth in real household disposable income per capita, which remained flat in Q2. So this is changes in disposable household income per person, adjusted for inflation and the cost of essentials. Bracket creep, rising mortgage payments, and a growing population have seen this income measure fall by 10% since mid-21. This leaves us pretty much as we were in December 2014, a decade ago. For context, in the last 2 years, the OECD average income measure has increased by around 3%. So with the RBA not expecting a return to 2.5% inflation before the end of 26, my concern is the longer-term scarring this stagnation may cause for households. Now, having said this, incomes have been underpinned by a really robust labour market. Employment and average hours worked continue to surprise on the upside, and some businesses are still reporting labour shortages. Another factor that has generally supported household consumption is residential property. So economic theory suggests that wealthier consumers tend to spend more regardless of their income. And house prices have increased around 7% year on year, equivalent to over $50,000 on the average house price. So despite tighter monetary policy, which has pushed the share of income required to service a new mortgage from around 30 to over 45%, property has remained resilient. However, prolonged high rates will likely exert some downward pressure on prices. So annual price growth has been positive. It has decelerated a bit over the last 6 months, with almost a third of suburbs nationally now seeing value declines in the last quarter. And for those hoping that the much discussed Treasury modelling of property investor tax concessions will lead to an abundance of cheap housing, the impact of this, even if implemented, would likely be minimal. Various studies estimate the influence of tax concessions on housing prices to be between 1% and 4%. So while discussions on equity and tax efficiency are valid grounds, it's unlikely to shift the dial on affordability. So as we approach the end of the year, Upcoming key data includes the Q3 inflation and GDP figures, which will provide further insights into our economic trajectory. The economic landscape remains dynamic, with both challenges and opportunities. But we seem to be treading the narrow path of bringing inflation down while keeping employment up. Long may it continue.